Welcome to This Week in Money. I'm Jim Goddard. Today, juggling dynamite author Danielle Park believes investors can no longer bank on the banks. Louis James from Casey Research says some great bargains can be found in the mining sector. Jack Crooks from Black Swan Capital braves the treacherous waters of currency trading. We'll talk to Danielle Park right after this.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Danielle Park, author of the bestseller Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle.
Hello, Jim.
Some interesting headlines on your blog where we're talking about reporters manipulating the market. How could that happen? And also new rules coming in for the banks. We'll maybe chat about how that's expected to affect markets. And do we need more rules for the bankers? And if there are more rules, will we see banking profits go down? Well, first of all, let's talk about rigging the market. That was a CBC story about how things are manipulated. And then your headline pointing out that Bloomberg has been paying bonuses to reporters who can, quote, move markets. Well, that sounds more like fiction than fact.
It doesn't sound much like journalism, does it? It's this whole gray area that we've come to in the last several years, where the sales arm, the marketing arm, has taken over the ethics arm. So we see that in many institutions and aspects of our society. We see that in governments. We see that in those who have fiduciary duty are being overruled by those that want to drive profits and bottom line. And you see it within money management companies, within banks, within institutions like the things that were typically supposed to be journalistic pursuits. So it's something that we've had in various times in history. I mean, whenever a bad guy gets in somewhere, the first thing they do is, Jim, is try and control the media and tell it what it can and can't say and what it should promote. And in this corporatocracy that we've developed over the last few years, with so little legislation controlling anything that's going on in the marketplace and so many people on the take, it's really corrupted everything. So that article was, it's not strictly speaking illegal for Bloomberg reporters to be paid a bonus to see if they can literally move the price of a stock, but it does have a lot of reminiscence for me of what was going on in other peak periods in history, including in the 1920s. And there's a lot of infamous data and stories about how markets were put up and down by strategically placed news items. So it really does smack of, again, a very frothy time, and why we need to go back to some basic rules and ethics and principles in our institutions. And so that's topical this week as well, because the Volcker rule was finally enacted. It's been, 3 years in the making. It was announced supposedly part of the Dodd-Frank bill that was proposed in 2010. I also read, interestingly, I think 45% of Dodd-Frank has yet to be written. Isn't that something, 3 years later? But anyway, Volcker was rolled out to keep some restrictions on what financial institutions are allowed to do in breach of duty and conflicts. And it's been watered down a hell of a lot, but it's a start. And I think it's a theme that we're going to see a lot more of, because whether it's a financial transaction tax, which the Europeans, 11 countries have signed on to bring this in as a way to recoup tax dollars from all the financial institutions that took handouts from the government in the financial crisis. This is a way to try and get some money back for society. And you're seeing that, in curbs on high-frequency trading and proposals to increase the bid-ask spread. That's another way to slow down the immense volume and speed of these rapid financial transactions, which, again, are serving no one. And proprietary trading, which has become this huge growth aspect of banks today and taken them away from all their traditional utility functions that served humanity into this big cesspool of rapid-fire trading, all to try and generate profits. So I say the next step now is to simply sever their connection or ability to have backstopping from taxpayers, and then they're free to go about their merry way and boom and bust as they will, no doubt. But at least it won't be on our tab when they fail.
Well, even when you bail out a motor company, we just found out the U.S. government has lost billions and billions after cashing in their GM shares. Mm-hmm. The taxpayers lost, what, $38 billion?
Well, it's how you calculate it, right? They point out that people kept jobs and therefore there was remittances sent in, payroll deductions and things that if they had lost those jobs, the government would have been out that revenue. So there's a bunch of different ways to calculate it. But at the end of the day, I think the most disconcerting thing here is that we now are left with these institutions that were not cleaned out or corrected or strengthened by failure in the financial crisis, but they were in fact emboldened to continue as business as usual. I mean, when you think about the fact that 2009 had the biggest corporate bonuses to executives ever in history. 2009, Jim, that's the same year that they literally all went into the tank and the taxpayer had to give them all these bailouts. And what they did wrong, frankly, was there was a whole school of well-established theory that said that if you have to be the lender of last resort to significant institutions in the economy, you have to do it at high rates of interest and on very unfavorable terms, so that they have a huge incentive to clean up their act, to stop wasting, to stop gouging and taking out too much by the C-suite, to really clean house and say, now you guys have these onerous conditions, you're going to have to earn your way back to being deserving of better fortunes. But what they did, and this was Bernanke and Company, basically, and Tim Geithner, they lent to the banks and the institutions on these extremely low paper-thin rates and all sorts of sweet deals. So no one learned, no one changed, and, they're back supposedly doing well right now, but I think that the next leg down in the economy will shake the foundations once again of those institutions because nothing was really fortified, strengthened, or improved.
More with Danielle Park next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Danielle Park, president of Venable Park Investment Counsel Incorporated. Danielle, in the past year, it looked like banking stocks were the way to go, at least in Canada. Record profits being reported by people like the Bank of Montreal. However, after they said they had a record profit, the very next day they announced 1,000 people were being laid off. How does that work?
Well, because the banks have been egregiously overvalued by two groups really, people desperate for yield who have decided they couldn't possibly wait for higher rates and they couldn't survive on what GICs or, high quality bonds were paying in the low rate environment of the past couple of years, and so they stampeded into things that were paying dividends. And there's this silly old rhetoric that always comes out whenever conditions are challenging. Broker-dealers of the world all tell people that the solution is to hold high dividend-paying conservative bank stocks, is how they always put it. And that, they always say a bank of commerce isn't going to go anywhere and all this stuff. But it's got nothing to do with that. It has to do with the valuations and the price. So it's roughly a 4 to 5 year cycle, and we've seen this several times where those, same high-quality institutions, their share prices will plunge in half. And so it's been a long time coming. If you look at the Canadian financials over the last 12 months, Jim, they appreciated something like 42%. And this is supposed to be, conservative. This is acting like a tech stock, and this is the financial sector. So they got so insanely above value that any good news is an opportunity for people to sell en masse. And we've really seen that. the financial index has dropped more than 4% in the past just a couple of weeks, and companies like Bank of Montreal are down now close to 8% on their share price, and everyone's sort of saying, wow, what's happening? It's all good news. But at some point the news was, the price went way past where news or prospects for the future could be, and it goes back to, what was the big drivers behind the Canadian financials in the last few years was the really huge spendthrift trend in the Canadian domestic economy. So everyone was spending their brains out, and now that trend is slowing at the same time that they're facing new capital requirements, they're facing more stringent restriction on their business activity, and those things will all squeeze profits. So I thought it was wonderful to see the papers and the Star, the Financial Post, and that sort of thing in the past week had big front page stories about how the CEOs of these large Canadian banks are all retiring now and going out at the top. No kidding, going out at the top. Good for them for timing, but I feel badly for the people who have been herded into those shares in the last couple of years, really with no idea of the capital risk they're facing to try and reach for that little dividend. And I'm afraid that, these cycles revolve to the downside heavily, and it always goes a lot quicker than people had expected, and then they're going to realize that there was nothing safe about those shares. The institutions themselves may well survive and, prosper for many years to come, but the value you spend for ownership in those companies has everything to do with how it turns out as an investment. And buying it at these, another great example, my partner Corey does a lot of charts on the banks, and he did a chart showing that, buying the Canadian financials at the past cyclical peak in 2008, you basically were underwater for several years. You were just basically trying to recoup what it was that you'd lost. And then it wasn't until really the last 12 months where people were, up so much that they had recouped their losses and had made some gains. But that's the part that now gets to be given back in the downturn. And so that's where people realize that price matters.
That's when you take a look, there go the banking stocks, bail, and hopefully pick the bottom.
Well, yeah, hopefully bail before the top. That's the other psychological trauma.
That's the other part, yes.
That people don't bail before the top. They typically stay too long, go down for the ride, and then panic when prices are, becoming attractive, and then they sell at the wrong time, and then they go to cash, and then they miss the rebound. So you really have to turn that process upside down and try and, leave before the downturn happens. And that requires a good amount of self-control and a bit of wisdom, a bit of understanding of how cycles work. Because, if you look at any of the main commentators, the bullish sentiment today was at a record high until just this week, Jim, like the highest in 26 years, the highest consensus of bullish views on stocks looking into 14. So we just have these sort of humble measurements that we take over time, and when you get a number of them flashing extreme consensus views, whether it's bullish or bearish, that's one of the things that suggests you're probably at a major turning point for the market cycle. I really don't think that that's either here nor there. I think that people, whether they do or don't, the expectation is that they have to start pulling back somehow, that they can't justify this unusual stimulus. But whether they do or don't, I think the reality is that corporate profits that have been at historic highs for the last couple of years have nowhere to go but down, really. To disappoint to the downside would be completely normal and healthy in this environment. And that's where the issue becomes. Everyone realizes, wow, without extraordinary stimulus continuing, or without additional stimulus continuing, and with profit margins already at the zenith level, then what is going to be a catalyst to make stocks continue to rise in this environment? And I think that's why, you're seeing a lot of institutional selling and a lot of people just finally saying, let me talk bullishly and let me sell with both feet at the same time.
Thank you very much, Danielle.
Okay, thank you, Jim.
After the break, Louis James on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at RandyElvisFrisky.com.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Louis James, Chief Metals and Mining Investment Strategist for KC Research. Welcome to the show, Louis.
Glad to be here.
We've been told that banking stocks, financials were the way to go for people investing this year, but I've heard from people who are in the know that even the banks themselves aren't confident they're going to be monster killers in the new year. They're laying off staff because they don't think they're going to be all that attractive anymore. They've kind of blown the whole thing. So I know metals, mining especially, a lot of stocks fell dramatically, didn't pick up. And I've been told if you know what you're doing, there's a lot of good bargains out there that should do very well for you in the new year.
That is indeed our mantra today. But let me say something about the broader markets first. We don't really have time to get into all the details, and frankly, I'm not an economist. I kick rocks and pick stocks for a living. But it occurs to me that there's a good metaphor for people who basically understand what's going on, see things our way. Consider, the Wile E. Coyote economics of our day, where they step off a cliff and they're windmilling in the air and they just haven't fallen yet, but you can see the pain is coming. And the thing about stepping off a cliff is that everything feels fine until you are, in fact, stepping on air. People are saying, wow, we missed the boat. We should have invested in Wall Street. Well, by results, yeah, you could say, sure, we should have invested in Wall Street for the last 2 years. Blue chips have done better than gold has done. But they've done so for the wrong reasons. And the rug can be yanked out, or to stick with my cliff metaphor, they can step off the cliff at any moment. Any moment that foot comes down and they feel that, whoops, nothing is there, it'll be very much one of those better a year soon than a minute too late, because those markets will go into panic mode pronto.
What about people who feel the equity markets are pretty well done, they've reached their peak, and are selling their stocks, taking the cash, waiting to see what the bargains will be?
Well, I don't want to time the market. The funny thing about the Wile E. Coyote economy is that it is, in fact, treading on air, but somehow it defies gravity. It defies logic, it defies reason, but there it is, floating in the air. It's got to fall. But who knows how long they can windmill in the air. I wouldn't want to try to time that. It could be that with all the money printing that they keep on doing, they talk about tapering, but I don't think they're really going to do it. They have no choice. And so, the gravy train could continue for a while. It's really hard to say. I wouldn't want to time that. But I would say more broadly, if I had made a bunch of money on mainstream equities, great, congratulations for making that sort of ironically contrarian play. But I would certainly take my profits. I would want to go risk-free. I would not want to bet the mortgage or bet the farm on Wall Street right now. That's high-risk speculation in my view.
You're taking a look now at what's happening to precious metals and mining today when, as we're speaking, gold took another big hit. And it seems to be creeping down to what I kind of call the magic line of the cost of production, where companies just simply couldn't afford to pull it out of the ground anymore.
Well, that might matter if this were copper or tungsten or some industrial metal that we were talking about. Though even then, back in the day, a couple decades ago, copper stayed under cost of production for years. So just because you can't make money mining something doesn't mean the spot price won't go lower, particularly in something like gold, where the recognized price is determined by a commodities futures exchange, not what it actually costs to produce and what the producer would like to sell it for, and what a individual might buy it for. If you could go to the gates of a mine and buy a 1 ounce coin, it might be a very different market. So I'm a little reluctant to go there, and let's go back to what you said at the beginning. What I feel much more comfortable about is simply saying that the whole sector, not just gold, not just even metals and mining, but the whole resource sector has been so whacked over the last couple of years that there are, in fact, tremendous bargains out there, companies trading for less than cash that have valuable assets in the ground, even at current prices, or companies that have the money in the bank to build their mine and are trading at a fraction of the net present value of that asset, or companies with great exploration success, not just speculation, they might find something, but success under their belt. They're drilling off great new discoveries, large, high grade, obviously high margin, and they've been thrown out with the bathwater and the baby and the whole tub out the window. Everything's on sale right now. So for the savvy shopper, it's a terrific opportunity.
I've heard kind of a rumor that Barrick Gold, the largest gold company in the world and is Canadian, might be in secret talks with China, which has been snapping up every little scrap of gold they can lay their hands on this year.
Well, that would be interesting, and exactly what those talks might entail, who knows? It's hard to tell with the proverbial inscrutable East. But I remember there was a while back, almost 10 years ago, I guess, the Chinese tried to buy Noranda, and the Canadians were having none of it. We're all equal opportunity. Nobody's erased us here, unless you want to buy one of our major mining companies. Then suddenly there are all kinds of legal objections to the takeover. So I would not expect, even though the Chinese have the money, I would not expect them to be able to buy a major Canadian firm like that. But some sort of
I was thinking
joint
more.
venture?
Yes, I was thinking more in the lines of supply. We want a lot of gold. Could we make a deal that maybe pays you more than market price right now, but if prices go up, we still have an assured price on an assured supply?
Right. Yeah, the majors are shaken enough that they might consider a large hedge, but of course they got beaten up within recent memory over their hedge books, so they may hesitate. What might be interesting would be, say, a large project that's on ice right now, like Cerro Casale. I think they would love to see somebody else's money go into that. And Barrick is right now suffering a big black eye with the Pascua Lama fiasco on the Argentina-Chile border. They've got not just Barrick. Let's not pick on Barrick, but there's depletion issues for every mining company. Every mine, the longer you run it, the less there is left. That's just the nature of the beast. So you've got to bring new things online. But the capex has gotten huge. The risks are high. There's political risk. I could imagine them being tickled pink to form a JV with a large Chinese gold producer over a big project with multi-billion-dollar capex like that.
Where would you be putting your money right now?
Well, I really don't think one size fits all there. If I was a more cautious investor interested in precious metals, I would be looking at production. I would be looking at stories that are making money regardless of the lower gold prices, that sort of thing, and then you get leverage to the upside. If I was more of a risk taker, not really trying to, look for a sure thing, but look for the 10-bagger, the proverbial out of the ballpark 100-to-1 shot, then I would look at the better exploration plays, the companies that actually don't have a bird in the hand yet, but have great people, great projects, great management. There's a whole variety in between.
How would you find out if they're really good hunters of gold?
Well, it used to be that being Doug or me and having years of experience was the only way to really know and sort the talkers from the doers. But these days, thanks to the internet, you've got Google, and okay, it's not perfect, but if somebody has a long string of failures, you will find that on a Google search. Or if somebody has a tendency to get sued for everything they do, you will find that on Google. So I definitely would not conclude that, well, you just have to trust the experts, follow the gurus. Today we have tools available to everybody. You can see the company's financials. There's a lot of interesting forensics that are available to any reasonably intelligent person. You don't have to be an expert. Just look at the numbers, see how they add up. Are they spending more on the office than they are putting in the ground? And like I say, you can Google search the people. There's a lot you can do.
In Canada, do we have a secret little place or a place that's new that's going to have a lot of promise and produce a lot of product that nobody's really talking a lot about yet?
Within Canada, no, I wouldn't say so. That's the sort of primo jurisdiction in the world. All the Canadian provinces are being eyed. There are people who make arguments for Manitoba. It's less talked about than Quebec or Ontario. People are looking, and there's less to pick from in Manitoba. So it's not the new Mecca. I will say though, here's an idea. For some bizarre reason that I don't understand, Mr. Market seems to have decided in 2013 that the Yukon is remote. Somehow it's more remote than it was in 2012. Like those darn Canadians picked it up and moved it farther north or something. It's a very strange thing. It's just become this vogue to criticize, those Yukon projects, it's too remote, there's no infrastructure, there's no power, blah, blah, blah. Well, it's true that the Yukon is remote and it's pretty far north, right? But that hasn't changed. It's nonsensical to criticize the place for being where it is. It, at the end of the day, all comes down to margin. Either you have a project rich enough to pay for ice roads if you need them, or helicopter drilling if you need that, or you don't. And there are projects in the Yukon, I think, right now that are being discounted because of this, absurd notion that all of the Yukon is unopened and unreachable, that are just, I think, screaming opportunities.
What about, I hear, for example, near Whitehorse, they have found the world's largest mine or diamond field. And that's about to go into production in a couple of years, and they expect to pull $50 million a month out of the ground there.
I don't really follow diamonds much. It's never been Doug's favorite thing, and they are a girl's best friend, but it's a tricky business. It's not a very transparent market, and I just don't feel comfortable speculating. I don't feel comfortable that there's a trend that I can rely on there, and it's usually big money.
Well, De Beers is a 50% partner, and I think they're one of the most secretive companies in the world.
There you go.
Try to dig up a secret on them. Looking forward to the new year, where do you think investors are going to be getting the best return without putting a lot of risk out? Or is that just pipe dreaming?
No, there are companies that have sort of willy-nilly make money programs. There are, for example, gold processors that toll mill for others, and they get paid for processing that gold, regardless of what it costs the miners to mine the gold. So, the good news is that if gold goes down, they still get paid. And unless the mine actually shuts down and they have no gold to process, no customers, they still make money. But if the bad news is if gold goes up, they don't really share that much in the rise in gold. So if I'm cautious, if I'm not sure where gold's going to go up or down over the coming year, but I want to have some exposure to the gold sector, then that might be the kind of company I'd look at, because there's the downside protection in the fact that they make money at any reasonably foreseeable gold price. And they will benefit from the upside just because they're in the gold space. But they're not going to go through the roof the way a company that's got a project that doesn't work today but does work at a higher price would change in valuation.
I've been told this has been what they call merger mania for a lot of the smaller mining companies, because without some extra support around them, they just wouldn't survive.
There's a whole interesting kettle of worms there. We have been expecting very active M&A because people would have no choice. You'd have a couple companies, maybe one has a better project but no money, maybe one has some money but their project doesn't work at a lower gold price. They get together and suddenly they have pieces that work. But that really hasn't happened. I can think of several companies that have basically no project and a large treasury, and somehow they can't seem to find anything better to do with that money than to buy back their own shares or just sit and wait. I find this very strange because there are great projects out there that are looking for funding. Funding is hard to come by these days. The other side, though, is just the people that are just out of money, haven't a prayer, haven't an asset, haven't anything. And we've been expecting a wave of bankruptcies for over a year now, and it just hasn't happened. I don't know how they're hanging on by the skin of their teeth. I guess they're not paying themselves, and everybody's on holiday. The office is gone. It's just a phone sitting in a dark little room somewhere. But at some point, that's got to change too.
Louis, always a pleasure to have you on the program, and glad to have your insight into this. Is there a website people can go to perhaps find out more about where KC Research stands on metals and mining?
Yes, of course, the basic website is www.kcresearch.com, and of course that's CASEY, like Mighty Casey at the bat, kcresearch.com. And let me say to the people that have been in the sector out there, a closing thought here. I know that the sector has been down, a lot of people have been bruised, but this is a tremendous opportunity to upgrade your portfolio. There's been a lot of money gone into the ground over the last 10, 15 years. Discoveries have been made, and those are on sale. So without the risk of who will discover, who make the big finds, we know who they are out there, and they're on sale. This is a time to upgrade your portfolio.
After the break, Jack Crooks on This Week in Money.
More and more people are looking to the internet. for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Jack Crooks from Black Swan Capital. Welcome to the show, Jack.
Thanks for having me, Jim. Happy to be here.
All this chatter about record highs on the equity markets, how precious metals took a huge blow in June and haven't come back. But I was wondering what's been happening in the world of currency trading and trying to maybe make a little money on that. Just before we went on air, we had a little chat, and it looks like it's been a very rocky year for some companies, and for others like yourselves, it's been good. What's been the difference?
Yeah, I think the difference is I think it's becoming difficult, or at least it has last year, and I think to a large degree this year too, of trying to trade the currencies with a macro fundamental view. For example, everybody, and last year I was on that trade. You know, the euro had to fall apart based on how badly the eurozone was doing, but the reality is the euro held up fine, and it's held up fine this year, even though going into this year, you know, there were dire views economically and, you know, from a macro standpoint, you know, about the eurozone. So that, I think, has really changed the game in currencies to a large degree and forced a lot of people to move more towards their technical analysis. At least those, I think, that have been successful this year are relying a lot more on just their technical patterns, trading in shorter-term time frames, as opposed to trying to play these long macro trends that haven't materialized to a large degree. I say that, but one has materialized, I think, and it's the British pound, you know, and this constant sentiment improvement in terms of how quickly the UK economy has improved has been a macro trade for the pound, but for the rest of the gang out there, not so much.
Right. I mean, I remember just recently the pound was down around 152, 150, and now 163. Wow.
Yeah,
I mean, in just a few months, what a huge rise.
It has. It's been a great run. And in the currency markets, you know, if you can pair the pound even against a weaker currency than the U.S. dollar. So if you pair it against the Japanese yen, for example, and do a pound Japanese yen cross, it's been a gigantic blowout move because we know how weak the yen has been against the dollar. We know how strong the pound has been against the dollar. So basically double that for a huge blowout move. You know, so the pound has been a hot currency to play against a lot of other pairs.
Looks like Britain made the right decision when they decided to keep the pound and not take the euro.
I think you're exactly right. It really gave them, you know, a lot of flexibility economically, budget-wise, and everything else. It allowed them to a large degree to control their own destiny, and I think it definitely was the right move.
We've heard from some people who've predicted the Canadian dollar is going to keep on sliding, perhaps hitting 88 cents by the end of next year. Has that been kind of the trend that you've seen?
It has. We've been short the Canadian dollar off and on throughout the year and have done pretty well with that trade. And we do see it, you know, in that ballpark, you know, by the end of the year. You know, I'm not sure if we have a target, right now, a near-term target around 91 cents. And then in that range, just from a technical standpoint, maybe it corrects, but, you know, 89 cents, you know, is not out of the ballpark.
For Canadian exporters, that would be good news.
It would. And, you know, we've noticed that, some of the jobs are, you know, a little bit shaky in some of the sectors in Canada, especially some of the exporters and also, you know, because of the materials fall, just the fall in commodities prices in general. I think it generally would be good news from that standpoint for Canada, and they wouldn't be unhappy to see it, continue to fall a bit.
I've seen Bombardier make some very large sales in just the last few days. Their reputation for making quality short-haul aircraft apparently is really, you know, hitting the world. And the fact that they'll be cheaper than they were if you bought it today, you know, in a year. Good news, I guess, for large exporters like that in Canada who haven't had a lot of good news recently.
Mm-hmm. No, exactly. You know, that helps. I mean, can't, overplay that. Obviously, the company makes good products that are in demand, but it's obviously the currency helps.
When people are looking at how can I make money in the currency market, it is a very dangerous place to play. You were just mentioning as well that 4X Concepts, the world's largest currency trading company last year, doesn't exist now.
Yeah, they went bankrupt this year, and it was really stunning. They had about, I think $14 billion in assets under management just a couple of years ago, and they're completely gone this year. And it goes to the point that we were just talking about, Jim. They based a lot of their trading on global, macro fundamentals and stayed with trades for a very long time that they shouldn't have been, long-term trend trades that were hurting them, that economically it made no sense. But yet the market does what it does. It doesn't necessarily have to make sense economically. And I think what really has, if I look at one thing and see what's changed in terms of the global macro side of trading on currencies, it's because of the fact central banks are all in the same boat, moving down to zero interest rate policies. And it makes it very, very difficult to judge money flow in that environment. So your global macros tend to break down a bit, and sadly, FX Concepts really got creamed because of it.
Quantitative easing around the world. I mean, the U.S., of course, has this massive policy of printing $85 billion worth of money a month, and hopefully somebody's going to snap up the bonds to support it. But what about other countries around the world? Have they been able to afford to do that, to keep pace?
Yeah, well, the funny thing is, if you look at the balance sheet of the European Central Bank, it's actually expanded faster than the Fed, if you can believe that, Federal Reserve Bank. And we know what the Bank of Japan's doing. They're pumping out money as fast as they can. So it's a pretty big competition between those three major central banks in the world, which obviously I think is one of the reasons stocks have done so well. The money has to go somewhere, and the real economies haven't rebounded much on a relative basis in this so-called recovery. So the opportunities have been in financial assets, and the liquidity has been created for that, and that's where it's all gone. So it's an interesting game, because what we didn't talk about this year is because of this central bank liquidity. Most people thought we'd come into this year and we'd see currencies move in those risk-on, risk-off patterns as they did to a large degree a year ago and even before. But we've seen changes in correlations also in the currency markets despite all this liquidity, and I think that's what's changed the tune too in currency trading. But we'll have to see how long this continues, and obviously everybody's handicapping QE when the QE ends. I'm not sure we want to play that game. We just kind of watch and see what the market expects and look for surprises.
Has that been the secret to Black Swan's success recently, is don't take a look at long trend terms, don't take a look at history, pay more attention to what's happening day to day?
Yeah, that's pretty well said. And we obviously look at history in terms of the historical chart patterns, because we do a lot of pattern analysis here. But to focus just on chart pattern analysis, as odd as that sounds, and technicals, really has made the difference for us this year, and not try and get wrapped up on a story, on a fundamental story. So that's exactly right.
At one point, China and India were talking about having a common currency. Is that negotiation still on, or is that off?
I would think that's off, just because of the political aspect there. I don't think those two countries get along very well historically, or now, especially even less now with what's going on in the East China Sea. I think most of those countries around that whole Asian region are very concerned about what China's going to do next. So I think any talk of a common currency there has to be considered a non-starter at this point.
Well, of course, the rupee has been hugely disappointing, and of course, there's the difference in philosophy between China and India. The Indian government putting huge restrictions on importing gold, and people have switched to silver, and they're smuggling more gold now than drugs into India. Meanwhile, China, the government has pretty well bought all the physical gold produced this year, and they're encouraging their citizens to stock up on gold as well. Two very, very different philosophies.
Interesting. I didn't even know that, Jim. That is very interesting. Interesting. I'll have to think through that one.
And plus, China holding all that U.S. debt. They must be scared about the U.S. economy.
Yeah, I think they are, but I think they're more concerned about their own economy. When you look at, there's a lot going on in the background, and I know I've talked about China off and on, and mostly from a bearish concern standpoint that hasn't played out. But I do think we're at a point now where after several years of tepid demand in the global economy, there's a general pressure, on growth in China. And the reason I say they're more concerned about that is because of the fact that they have a lot of debt built up in the system that isn't official in the shadow banking system. So they really have to figure out how to keep all these balls in the air, while the global demand picture really isn't that great, despite, we're told about recovery here and there. But if you look at, trade and money flow globally, based on trade, it's just not there relative to the amount of capacity China has. So I do think they're more concerned about their local economy than they are about the U.S.
Right. I've heard reports that Chinese government officials are very worried about their surplus capacity in so many areas of production. Now, if the world isn't doing all that well compared to China, are they trying to fire up their own consumers to maybe pick up some of the slack left by North America?
That's really their long-term policy, but it's not something they can do overnight. That China very much understands the problem. Their leadership's pretty shrewd on this. But the problem is that they've relied so much on an export component and internal investment to drive growth. And, it's just very, very hard to make that transition because you have a lot of powers that be, the princelings and other powerful people in China that want to continue, the current, economic policies. And any attempts to make the transition is going to result in slower growth, regardless, even if in the long term it's the best thing for China. So at this point, they're a little worried about trying to move quickly on the consumer side, given, the global demand background. So they're trying to they're wrestling with this, but it's an open question of how it's going to play out. It's a very dangerous time for them, and I also think because of the concern, growth, I think that's leading them to be more aggressive internationally in foreign policy. So I think that's all part and parcel. You have to understand that the Chinese currency relative to the Japanese currency has appreciated tremendously. So they're getting huge export pressure against Japan, one of their major competitors now in the area. So that's leading, I think, to some of this corrosive politics. So I think it's a fairly dangerous time in here for China. So we'll have to see how it plays out. But there's some pretty nasty scenarios out there. But there's been a lot of scenarios like that in the past. The difference I do see this time is the growing political rift between U.S., Japan, China, and the tepid background of global demand out there. These are two major global macro events that are stacking up at the same time.
Well, some people are questioning China's new aggressive defensive policy, where they're claiming little islands here and there, and they're part of their air defense zone now. Places that just a few weeks ago you could freely fly through, now you might get shot down. Are they trying to deliberately cause tension, or is that just a result of the way the economies have gone?
It's an interesting question. I discussed this with somebody just yesterday, in fact, and he asked me what's China's intention here. I don't think it's a surprise that they want to grab more resources. It's what every major power usually has done in history. The timing is suspect, though. And I do think, and I don't know why the timing is now, because I think it's created an extra bit of pressure, and because of the global environment, the global macro environment, countries can use these contexts, to drive, to create more nationalism, when they have pressure on the jobs front. And I think that's part of this, this policy in China. But there's something else here that I'm probably not seeing. But I do think it could be very, very dangerous, because what happens if a Chinese pilot, just makes a mistake and fires off one of his missiles into a Japanese fighter pilot? then the whole game is on. And the problem becomes the U.S. by treaty is forced to come in on Japan's side, whether or not we think Japan is handling it right or not. And so far, I don't make those decisions, but this could be one of those situations where an accident could lead to a real conflagration for the markets.
And that's something that a company like yours that takes a look at the action of day to day, perhaps even hour to hour, when it comes to trading.
Yeah, we watch that very, very closely, that area, because needless to say, it's the area of global growth, and it's where a lot of resources are shipped through that whole. So if there's an impact there, it'll ripple through every traded asset market in the world very, very quickly. We do think if it happens, you're going to see, if there's an accident there, you're going to see the U.S. dollar and the Japanese yen appreciate at the same time, because you'll see a lot of Japanese money return home for safe haven with a money flow, and you'll see a lot of U.S. international investors suck that money right out of Asia, and it'll come back into U.S. dollar. So if there's an accident there, those are the two currencies we want to be in. We want to be long Japan against somebody and long the U.S. dollar against somebody.
Is there a website people can go to check out your company?
Sure. It's blackswantrading.com.
Thank you very much for chatting with us.
Jim, thanks for having me. It's always my pleasure.
Thanks to our guests, Danielle Park, Louis James, and Jack Crooks. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.